All right. Thank you very much. Um, Thank you everyone for attending this session. Um, Take you through just the financial reporting and things to consider and how you can elevate that um, your reporting so that you are able to um, get to that next level. So um, we will go to over today. We're going to go through just an introduction. We're also going to talk through kind of just where do companies start from and where do they end up going as they go through their cycle of growth. The interplay of internal and external reporting, and then how do those relate to the relationships that you should be fostering. Um, so start with myself, Adam Schlepper, CPA with CLA. We've been construction specific for over all of our history back to the 1950s, actually. And I've been in construction here for 12 plus years. CLA has 5 offices in Texas. And as you can see quite on the map there, we're really across the country. We're actually the 8th largest construction or CPA firm in the country. But we also, the thing that differentiates ourselves is we really serve those private businesses and their owners. And so we don't do any SEC or publicly traded companies. And so we work with those that are doing $20,000 in revenue a year, all the way up to $1 billion. The key thing is that they're all family owned, and they've all gone through the cycles that everyone is going through as they start out. So progression of the company's financial reporting. So I'll take you back to when I first started. I think through the thing that got me interested in construction to begin with was actually my next door neighbor. He owned a drywall company, and so I was a construction laborer doing drywall. And the only thing I can think of from his financial reporting looking back is the back of the napkin. That's how he ran his company. His windshield had Post-it notes all the way across the front windshield, all over the place. And that was how he kept track of all of his bills monthly. And you'd see him at the end of the month, he'd go and take different ones down and end up bringing those in. And so you think about that as where most people start, right? When you're starting a construction company, it's really a pickup truck and yourself, and you're going out there and making things happen. As you progress, though, you start thinking, okay, well, I need to report now. Well, what's the first thing that comes up? Well, your taxes. So most people will generally go to QuickBooks. That's the most common option that we see. Those are usually set up on a cash basis, which is also the tax basis. And so the first people that you usually get introduced to is someone that's going to do your tax return. Might not be construction specific, and they really start going through just really making sure that you get your cash in the door. That's when you actually reported your revenue. Well, as you progress through that, your sureties and banks, they can only rely on that tax basis for so long. So what do they want? They want you to go to the accrual basis. What's that mean? They really want to know what's out there that you might that you have a liability for that you haven't paid for yet. Accrual, the cash basis doesn't do that because you haven't actually paid for that, paid for those expenses yet. It also picks up revenue that you haven't built yet. You might have performed something, but you didn't actually bill it. And so if you didn't bill it and you didn't collect it yet, you don't have that revenue. And so it can be the fluctuations based on timing because you're busy serving clients, you're out there doing the work. If you don't get to your back office and get the billing done, you won't show that revenue. But then, like my example of my next door neighbor with all of his Post-it notes, he goes and collects those. Well, maybe he collects those in June, and he hasn't done that since December. Well, now you're going to recognize basically all that revenue in that month. that's not going to be as much of a flow. That doesn't allow a surety to be able to estimate what your actual efficiency is and how profitable you actually are. And so what will happen is the sureties or a banking from a line of credit side of things, they're going to ask for you to get external CPA statements. And when you look at that, you really have to look at now a person that is a tax only accountant. They may be knowledgeable in construction if they focus specifically on construction, but the financial reporting of construction companies is very much different than tax basis is, especially as you're starting out. After you get over about 25 million in revenue, then the tax code and the financial reporting actually does mirror each other. From there, we move on to the, you're still on QuickBooks, doing your CPA statements can very well do that, but you're going to outgrow those at some point. And most people end up investing in a construction software. That might be Foundation, Viewpoint Vista. There's a ton of different options out there, and they're all very good. The consultant that we have that helps in the selection of those software things, his mantra is, how do we turn one project manager into 3 without actually adding a project manager? And then also, how do you connect your back office to the field? Because the field is what generates all the reporting. And if your software isn't able to track that and your systems aren't able to track that in a timely manner, it makes it really hard for those business owners to be able to manage their company as it grows and understand what's going on. You're very knowledgeable, you understand everything if you have that information. When you start out, you're in the details, you're actually doing the work. So, as you grow, you're going to have project managers, you're going to have others out there that you're not able to be on site every day. And so the construction softwares that are out there now help in that aspect. The other piece that they do is they do really well in reporting your financial statements. So instead of having to pull your data from QuickBooks and prepare your statements, the software, you can, for all intents and purposes, can just click print. And that's what everyone will strive to get to at some point. So as we move on here, now that reporting that we're working on. So you got internal reporting. That's a monthly, quarterly, some it might be yearly. How does your closeout process work? You want your closeout process to be done on a monthly basis so that you can timely report your financial statements. The other piece that you want to work into is, how do you make sure that what you're reporting internally is going to match that external report when that external CPA prepares that report? That closeout process helps. What I always suggest is mirror those outside statements. Have your internals look exactly like those external reporting statements look. When you do that, the external statements, your internal statements will be much easier for those that are using them to actually rely on them. If there's big swings, big differences, they're going to start asking for more external reporting, which is just going to be more costly. And the other piece of it is, if you're not up on top of the reporting on a monthly basis, as I discussed before, you're not able to make those timely decisions that you need to make and be able to identify those problem jobs before they become too much of a problem that you're not able to get a change order in, you're not able to have that discussion, maybe change course. Is it a poor project manager on there? So those are the focus of really your internal reporting. When you go to the external reporting, that would be when you would come to someone like myself that does the reporting for you. We're independent. We're taking a look at your books and we're giving some assurance levels. Now, there's 3 different really levels of the external reporting. Most companies will start with a compilation. That is simply just taking if you're on QuickBooks at that time, or taking those napkins, taking those Post-it notes, and putting it into the form of a financial statement. Those financial statements are going to have a balance sheet, an income statement, statement of equity, and a cash flow statement. You're also going to end up with the full financial statement notes. And then you'll also have the what we would call supplemental schedules. They're not required, but your users actually, that's really what they rely on heavily. And that would be your work in process, or work on hand, schedule of completed contracts, schedule of in process jobs, however you may call it. There's a number of different ways, but most commonly WIP. Then as you progress and your jobs start getting bigger, the external users are going to start requesting that you get reviews done. The reviews is just a higher level of assurance. Those reviews are actually, they're going to look, other than the actual report, they're going to look very similar to a compilation. The only difference is that the process that we use to get there is just put to the next level. This becomes inquiries. This becomes the analytics. We're going to look at differences in accounts. What happened here? Why did this amount go up so much when your revenue did not go up that much? Any of those type of questions we can see. Or did you have a big G&A expense that you didn't have in the prior year? What happened there? And it's just trying to get that understanding. Did all of those expenses that are yet to come, did we account for them? Did you accrue wages? Do you have a large liability sitting out there for workers' comp or general liability? Or on the other hand, did you pay for your full year's policy in November? Well, you're going to use that over the course of the next 12 months. And so you've only used 2 months. So we should have 10 months of that recorded on the balance sheet as an asset. And so that's what the review does. It's really just gives the users a more comfort level. And then as you progress even further, the audits become in, and that's when you start looking at internal controls. What's the size of your accounting department? Who might have access? The audits, in our experience with privately held companies, most companies do not need to go to an audit. Almost all of them, probably somewhere in the 80% range, only will need a review done. Time that you need an audit is when you get really large and you might need a large line of credit. You might have some big assets that you're financing, or your jobs are getting very large. And so you end up with the requirements from the bonding capacity to have audits done too. I always steer everyone, if you can get by with the review is the sweet spot. That gives the most assurance with the least amount of cost. It's the most beneficial to most construction companies. I have not seen too many bonding programs that actually require the audit. So my recommendation would be ask those users, do we really need to go to that audit? What can we do that can keep us at the review? It's not they're not that difficult, but it's a bigger time commitment from not only your staff, but those that are going to be involved, and it can be much more of a disruption. So how does that all work with the external reporting? Those users of those statements, they really need to understand which level of assurance they need, that you are required to have to properly fund your programs. But then they're also going to ask you for going back to your internals. Once you start getting those reviews and compilations done, how does yours match? Does it match? Those are things to think through. one of the, if they don't match, what we've seen done is you'll have bonding agents and bankers actually require you to have quarterly or semi-annual statements done before they can issue you that bond. So it's just really important to understand which side, what you're doing internally versus what you're doing externally. The other piece with the internal reporting, if that is done in a timely manner, when you get to your external reporting, it'll be a much smoother process because of the books will be in order and we'll be able to get through those reporting in a much more timely fashion. The external reporting, one of the other things that I would mention is that those supplemental schedules that I mentioned previously, those aren't a required item. So what we do, we will produce when CLA does statements, we'll actually give what we call a short version and a long version. That's to know who's your user. The bank, most of the time, the bank, all they're going to want to see is, do you have the equity and were you profitable? So you can probably give them the short version. What's the short version? The short version is purely the income statement, balance sheet, the statement of cash flows, and your notes. It stops there. So that would be what you consider the basic financial statements. The long version, what we call, is that includes supplemental schedules. On there, we're going to have your closed job schedule, your open job schedule. We're going to also have a schedule of your construction costs, so your direct job costs. And we're also going to have your schedule of G&A expenses. The users of that one would be your sureties. They're going to do what we call a fade analysis on your jobs to see how they're performing. How did you report versus how did they finish? What they're really looking for there is to understand what's the estimating ability. If you're saying the job is going to end up with with 15,000 of gross margin, did it end up with 15,000 of gross margin? Well, if your history shows that your contracts are always fading, which means that they don't end up with a 15, they end up with 5 or maybe even a loss, that puts the risk level of those statements at a higher level. And so really what we're looking to do is ensure that we're being conservative so that when you get to that point and they're looking at those jobs that are listed out, they're able to tell you, hey, these guys know what they're doing. They're on top of things. They got this new big job. We gotta bond them that's bigger than we've ever bonded them. I know all their estimates have been spot on from the get-go since we started working with them, or we've seen improvement in it. Well, if that's the case, then they can say, hey, they estimate they're going to get a 10% margin on this job, maybe even 15% margin on this job. Okay, that's probably, we're comfortable with that. Their balance sheet is strong. They have enough capital. They have that line of credit that they need to fund the statements or to fund that project. Yeah, we'll give them that performance bond on there. Because most likely based on past history in that estimate, they're probably going to come in at 16%, 17%. You're going to see actually pickup, so they're going to perform better when they actually close out. So those are all things to consider when the interplay between your internal reporting and your external reporting. Those relationships that I've mentioned already to kind of foster, your surety bonding agent, they're really your advocate. You want them to be your advocate. They're going to be those that can really, they can find the insurance companies that are going to issue those bonds. And with doing so, they can tell the story based on your internal statements, based on those external statements and their past history for you. One of the things that that you can progress to is actually getting a program set up. You'd have a capacity of $1 million, $2 million. You'd have that cap, that bonding capacity that they can say, yeah, if the job comes in at $500,000 job, hey, your bonding capacity is 2 million. Yep, here you go. Here's your bond. It's not as much of a struggle. And really what that goes back to is, how is your financial reporting? Have you progressed? Can they rely on those numbers? If they can get you good deals. The other thing that I've heard is that the pricing on those bonds, if you're able to, one, show consistent reporting, and also if you're able to get a review or an audit done, generally it takes at least a review. The pricing on them is more beneficial, because reason being is they've had someone from an outside party that is able to come in and say, yeah, these numbers are good. These numbers make sense. Took an independent view of them. They're good, versus someone saying, oh man, I really need to get this job. Okay, I'm going to give my internal report. I'm going to show that we're making a lot of money, when the truth of the matter is that that's not actually occurring. We work very closely with those bonding agents. You look at it as a team. What's your complete financial team? The other people that you'd want to be involved with that is your banker. They can work on your working line of credit. That can help those jobs. Payroll, if you're, depending upon how your schedule of values is set up and how your client is, the owner, it might be 60 days before you get any cash in the door. Well, your crews, they can't go 60 days without getting paid. That's where that working line of credit can come in. The banker is going to be a critical piece of that. And it also aids in your bonding capacity. Reason being for that is that you get an additional working capital, because you have that availability of tapping into that cash. You don't have the cash in the account, but you'd be able to tap into it. The other one is, as you continue growing, you might get a new project. And if you have that good relationship with the banker, hey, you call them up, hey, looking to buy this piece of equipment. We need a front loader for this new job. We don't have one yet. Or all of ours are being used. Even better, all of ours are being fully utilized, and we got more work on the books. Call the banker up. They can get you that asset loan. And you can see actually get programs set up with those two, where you will get you'll have basically a note payable that you can draw on to fund those asset purchases. How does that all work? Well, they can put the reliance in there if you're able to produce good financial statements and reporting in a consistent basis, and really develop that relationship. If you really want to look at your financial team, it comes down to your internal reporting with your internal team. Do you have a controller? Maybe you have a bookkeeper, whichever level you have, but it comes down to them and yourself. The reports that you're able to produce internally, those reports being able to match your external reporting. And so that's when a good CPA comes into play. And then you can also work that in with your banker to fund those projects. One of the other things I just wanted to mention too, when you're considering, hey, who's going to do my external reporting? The bonding agents will look at those. What's the experience? Construction is much different in the accounting than, say, a retail. Retail is pretty simple. There's not an estimate. There's a set price for the good that you're buying. Did that get sold today? Yes, it did. Okay, that's a sale. Very, very simple. Construction, there's a lot of estimates. Does your CPA understand how those all fit into the picture, and can help you progress through that reporting process, so that the bonding agent has what they need, that you have the reports themselves also show enough detail. One of the things that just came out was 606, or revenue recognition. Contract assets, contract liabilities. No other industry has that. So are your statements presented in that way that gives the users of those statements the information that they need to make those proper judgments on the ability of the company to be able to perform on the work that they're trying to bond. So Samantha, I don't know if there's any other, if there was any questions or anything that came in. I think we got about 5 minutes here.
Yes, not so far, but we can give them a few minutes to type in their questions. Did you have a contact information that they could reach out if they had any follow-ups? Perfect.
And I know on the webinars webpage too, and my LinkedIn is also connected there. I guess that the other thing I just mentioned is, we're across the state of Texas here. I'm currently in the Dallas office, but we serve clients throughout the state currently. And most of the construction at this point is in the Dallas office, but we're very remote, but we also travel. It's great to see people in person, so I'm looking forward to those being more in person as we continue through and get through this pandemic.
Yes, and we do have a question from Corinne Crowell. Are there some firms that are construction specific that are preferred by bonding companies?
I think it gets to be what the real fit is. Bonding companies what they're really looking for is you'll have some firms that will say that they're industry, but they don't really have a focus on it. So what they're looking for is those that are really invested in the community and really are involved in the different associations, and then the reporting side of it. From a bonding perspective, if you're able to produce statements that have both those supplemental schedules, the closed and the open job schedule, that's what they're really looking for. But the way that each bonding agent has those that they're comfortable with, and so that's why I talk about it as being a team, because it goes hand in hand. If an agent that I work with knows how the statements are that I've produced, that he's looked at for multiple different clients, that's going to give him a comfort level. And so really you look to your bonding agent to give you direction as far as who they might recommend. And usually they'll have a couple, and then from that point, they would give you their contact info, and then it's up to you what's the right fit. I won't be the right fit for everyone. And so it becomes, how can you and I develop that relationship and have that good working relationship and that connection, so that we have a great working relationship back and forth and can have a candid discussion on everything.
Of course. And Corinne has a follow-up question. Do you work with startups?
We do. So our firm has, at the bottom you can see the outsourcing. We actually have a whole biz ops department that helps too with the startup stuff. So if you don't have that internal reporting right now, we can assist in that accounting until you get to grow to the point where you need someone there every day. But yeah, we work with anyone $25,000 in revenue. It really doesn't matter. It's really zero on up through the entire life cycle. And that's really what I'm passionate about. What I see is seeing those companies grow and the success that they have.
Awesome. Okay, it looks like we're right at time. If there are no more questions, Adam has shared his contact information, and this presentation, along with the recording of the presentation, will be available for our attendees on the Whova app and website. So if there are no more questions, thank you so much for your time, Adam. We really appreciate it.
I appreciate everyone, and feel free to reach out. My contact info there. Happy to help in any way I can.
Awesome. Thank you again.
Thank you.